If you like the idea of collecting rent, but hate the idea of chasing tenants, fixing leaks, or swapping light bulbs at 2 a.m., REITs as an asset class may be one of the closest things most investors get to being a landlord without the headaches. So a real estate investment trust, or REIT for short, essentially pools money together to buy income-generating properties. You can think of them as acquiring shopping malls, office towers, logistics warehouses, hotels, or even owning hospitals. And instead of just owning one condo with one tenant, you now own a slice of the entire portfolio of properties. And at the end of the day, the dividends you receive are essentially your share of the rent after minusing out the cost. So many REITs are built to pay out most of their income on a regular schedule, which is why they're staples in income investing portfolios. So one practical note is that in Singapore, distributions from locally listed REITs are typically not taxed at the investor level, while distributions from the US listed REITs paid to foreigners usually might face withholding taxes. When you first look into a REIT, you'll quickly hear this term called DPU. It essentially stands for distributions per unit. And that's essentially the total cash a REIT paid you per share over a specific period, usually over the last 12 months. And if you divide that DPU by today's share price, you get this thing called the distribution yield, which is the headline percentages everyone talks about. For example, if a REIT actually paid you 10 cents over the last 12 months, and the share price is say $2 per share, the yield is essentially 5%, 10 cents divided by $2. And that number isn't pulled out from thin air. It comes from the real buildings collecting rents, paying the bills, and passing most of it as profits back to investors. And here's what makes them special, especially for beginners in this REIT investing space. It's more likely than not how tangible they feel. Think about it. You can stand inside a shopping mall or drive past a logistic park. You could intuitively get a feel of the building's rents, occupancy rate, whether there's enough merchants, and clearly its location. You can also get real diversification for small money. So instead of all your risks sitting in a single apartment and a single tenant, a REIT basically spreads out the risk across hundreds of leases and multiple properties in different places. And of course, because REITs are listed, you can buy or sell with a single click. So on the surface, everything sounds pretty good. But real estate, let's not forget, is still a pretty cyclical asset class. And the financing structure also matters a lot too. Think about it. REITs borrow money to buy properties, just like any of us. So they are pretty sensitive to interest rate environments. So when the rates rise quickly, interest expenses also climb. New acquisitions get harder to become yield accretive. And sometimes, valuations get marked down, especially in trying economic moments. In contrast, when rates actually fall, the REIT may benefit from lower borrowing costs immediately, but actual DPU increases really depends on how fast they can renew their leases at higher market rates and whether there is a sustainable rental growth in the REIT's property portfolio. The point is this: the underlying property economics is still the main driver of both growth and profitability. Even though, yes, the natural interest rate environment do affect them to a very large extent. Now, let's do a quick tour of the main features to help you understand why one 6% yield isn't the same as another, even though they're all under the REIT asset class. Let's first talk about office REITs. So office REITs owns naturally and intuitively office buildings, and their leases tend to be roughly between 3 to 5 years, and location is king. In markets with tight supply and stable demand, Grade A properties tend to hold up, whilst in market with too much spaces or heavy work from home pressures, rents and occupancies tend to come under strain. Retail REITs on the other hand, so they own probably your shopping malls and street level retail. So in dense cities with limited land, like for example Singapore, suburban malls anchored by essential spend tenants can be extremely resilient. And the flip side is your mum and pop tenants who struggle in downturn and the long-term shift to e-commerce. Moving on to industrial REITs, they tend to cover warehouses, logistic parks, and increasingly we are seeing data center REITs as well. And this category of real estate investment trusts has benefited from the long-term tailwind of e-commerce and the AI-driven data growth. And they tend to also have medium-length leases and they have relatively lower upkeep. Next, you have your hotel and travel-related residences. They are great when travel is booming, but they tend to be tough when tourism actually vanishes. And they're often structured with a base rent plus a variable component. And the last part, we have healthcare-related REITs. They tend to be leases to things like hospitals and the aged care operators. And they typically have long leases, much more defensive cash flows, but the growth actually relies more on acquisitions than big rental spikes. And let's not forget, at the end of the day, the underlying asset that you're owning here is still real estate. And two main factors actually drive your investing outcome: the income and the value. On the top line, the income portion is naturally your DPU, and the value portion is what happens to the properties and the net asset value over time. Intuitively, if the leases are renewed at higher rates, it naturally drives up the income. And if they're able to transform dead spaces into rentable spaces, and if the REIT manager is able to recycle their assets from a weaker one to a stronger, higher yielding one, you tend to see your DPU and net asset value rise over time. And that's where the better REIT managers earn their keep by improving the portfolio without stretching the balance sheet. Conversely, your undisciplined acquisition, your high leverage, or just buying up trophy assets at low yields can inflate the asset under management, but it will naturally dilute your unit economics and ultimately impact your distribution per unit. Now, another common terminology used here is called gearing, and it's simply the debt as a percentage of the total assets for the REIT. So the lower the gearing is generally expected to be safer because interest has to be paid whether rents are strong or soft. Many investors tend to be comfortable when gearing is around the high 30s to near 40% range. If you push it too far and a tough economy actually comes, it can force different asset sales or just raising of equity at the wrong time. Another term called the interest coverage ratio tells you how many times earnings can actually pay the existing interest rate. So the higher the number, it means that there is more cushion. And then there is also the cost of debt and how much of it is fixed versus floating. So if most of the loans are actually locked in, rising interest rates actually hurt lesser. But you'll also be slower to benefit when the rates actually fall down. In short, there isn't a one-size answer of what is the right number, but there are definitely rule of thumbs to follow. And valuation is also usually an area where new investors often get tripped up. With regular stocks, people watch things like the price to earnings ratio as a benchmark. With REITs, I think two simple anchors are distribution yield and the price to NAV. So on one hand, the distribution yield tells you what investors are willing to pay for the current run rate of the dividends that they're expecting to get. On the other hand, the price to NAV tells you whether the market is valuing the REIT above or below the appraised value of the properties after subtracting the debt. So if you're paying a very big premium today, you're assuming the assets will deliver more than the current consensus, or that the REIT manager will be able to create value quickly. But if you buy at a wide discount, they tend to be under 1 times book value. You might get a tailwind if the gap closes, but sometimes, let's not forget, a discount exists for a reason. More often than not, because the assets are challenged or the balance sheet is stretched. Meaning to say, the REIT isn't exactly performing very well. Hence, it is up to the individual investor to make the judgment whether or not before investing into the REIT itself. Lastly, a quiet yet important piece is the sponsor and the REIT manager themselves. So many REITs are launched by large property groups who seed assets and provide a pipeline of different property investment. A strong sponsor can open up financing doors and seed good deals, while a weak sponsor can be a risk, especially if the sponsor is also a master tenant on long leases. Meanwhile, the REIT manager is the driver. So two REITs can own similar malls and face the same economy, but the one that pushes for renovation projects thoughtfully, recycles capital from weaker to stronger assets, and stay disciplined on leverage will usually deliver a steadier and rising DPU over time. So if you're learning how to evaluate REITs, a screener can be a useful tool to sort by factors like yield, sector, or gearing. So in our new income investor course, you'll learn the criteria and benchmarks Adam Khoo actually used for selecting quality REITs. And you can access the Piranha Profits REIT Screener as a bonus when you enroll in the course today. So link will be in the description below. Now, let's take a look at the pros and cons of the REIT asset class in general. So on the plus side, you can think of REITs as making property income accessible with extremely small amounts. They deliver diversification across many leases and location, and they pay out regularly by design. On the risk side, however, they are interest rate sensitive, and they're not immune to structural shifts. And the idea of leverage tend to magnify on both the good and bad periods. And while REITs aim to pay out most of their income, distributions can be adjusted when the cash flow tightens, so the headline yield that you see is actually not a guarantee. And if you're wondering how REITs actually stack up against other income assets, the cleanest comparison is actually what sits underneath all these asset classes. So let's first talk about dividend-paying stocks. So when you're looking at stocks in general, you are investing in operating businesses whose their board decide how much to pay you and when to pay you. Moving on to the REIT asset class, the REIT distribution itself is usually anchored in rental economics. So their growth often comes from the rental escalations and how they move between different assets and how much it yields underneath them. So compared to the third asset class, like bonds for example, REITs usually offer higher yields because you are taking on equity-like risks on property values and their leases, not just lending to an issuer for a fixed coupon rate. So neither of these different asset classes are better in all seasons. They just rhyme differently in the different economic cycles. And one nuance that I hear increasingly, especially in such an environment, is on this issue of timing. So if policy rates are expected to fall, it's tempting to think about, oh, it's great for REITs. Often, yes, because lower rates actually reduce interest expenses and can hold up or support property values. But it's not automatic. However, if a large portion of the lease actually resets slowly, it takes time for higher market rents to flow through. And if a market is oversupplied, say too many offices chasing too few tenants, the lower rates actually don't fix a vacancy problem overnight. So you can't just stop your analysis at the first order thinking, saying that just because interest rates are falling, all the REITs are definitely going to go up. And if all of these sound like a lot to digest, there is also the basket route, basically REITs ETF. So they bundle many names into one ticker, giving you the instant diversification by sectors or geography and taking away the need to pick winners. And the trade-off, it's naturally an extra layer of fees and the reality that an average basket can never outperform a portfolio of carefully curated and selected high-quality names. So for those of you interested in creating an income portfolio, you might ask, where do we go from here? I think REITs definitely deserve a place at the income table because they translate land leasing into a regular stream of income that you can plan around with. What's important is to understand first what properties the REITs own and where, how healthy the tenant base is, how long the leases last, how conservatively it's financed, and whether the REIT manager has a track of growing DPU and net asset value through different environments. And if you keep these in view, I think REITs can be a very sensible and reliable income vehicle. And if you want to go deeper into the full selection framework and to see how Adam Khoo himself picks his portfolio of REITs to supplement his income portfolio, you want to check out the Income Investor course. Remember, when you enroll today, you'll get access to our own Piranha Profits proprietary REIT screener and the portfolio tracker at no extra cost. You'll also discover how income-focused investors use passive income assets like dividend stocks, bonds, and even private credit BDCs to craft portfolios designed for your own cash flow needs. So click on the link below to check it out, and this is CK from Piranha Profits signing off. Till next time, keep winning.